Hi everyone, Alessio Rastani here of Leading Traders. So it is going to be a very big day today, and that's because, as we've known for many months now, today is FOMC day, and it's a very special FOMC day because that's when we're going to find out when at 2 p.m. Eastern or 1900 hours GMT UK time, we're going to find out if Uncle Ben, Ben Bernanke, is going to announce tapering or not. Okay, so is he going to scale back on the quantitative easing or the $85 million a month bond buying program? So that is going to be a very big news today, and expect a lot of volatility in the market. Now, here's the strategy that I want to employ today. And of course, this is the best time, the perfect moment really to execute this strategy. And it's called the FOMC ABC strategy. Okay? And the way you play this strategy is actually quite simple to understand if you just focus on it. So we know that the time for the FOMC announcement is 1900 hours, which is essentially 2 p.m. Eastern. Okay, so when that announcement comes out, here's what you want to watch out for. So when the announcement is made, okay, what you have to watch out for first of all is a big move. Okay, now you probably won't know in advance which direction that move's going to go, and I wouldn't try to guess it. It's not important. But here's an example of an FOMC announcement back in June, and here's how it works. So notice when the announcement came out at, as you can see here, at 1900 hours, okay, a big move occurred. That was the big move was to the downside. Okay, now this is called wave A. Okay, so move A, and it's also known as the true move. All right. Then what you want to watch out for. Now remember, no trades at this point. You don't place any trades at this point. What you want to wait for and watch out for is the next move. By the way, I notice I'm doing this on a 5-minute chart. Okay, it's a 5-minute chart of the S&Ps. Now you can do this also on the Dow. Okay, so you can do this on the Dow, Dow Jones Index. You can do it on the S&Ps as well, but I like the S&Ps personally. You can also do it on a 3-minute chart and a 2-minute chart, whichever you prefer. I'm using a 5-minute chart here for this example. So really, all you're going to watch out for is, first of all, wait for the true move, wave A, okay, which in this case was the downside. Okay, so that's wave A. Then what you wait for is the retracement. The retracement came here, as you can see here. Then this is the fake move. The fake move is usually in the opposite direction to wave A. Okay, and again, that's wave B. Okay, so we're going to call this wave B. This is the fake move. Okay, so remember, it's in the opposite direction to wave A. All right, and this is where you want to enter. Essentially, what you want to do is put 2 moving averages on your chart. I've got a 21-period moving average here. That's that blue line you see there. And I have a 50-period moving average here. Okay. Now, on a 3-minute chart, you can use different moving averages, like a 21 and a 200 moving average. But really, it doesn't really matter. But essentially, this is where you want to enter. So you enter once, you scale in bit by bit in small amounts. So you enter one set of contracts here and another set of contracts here. So for example, if you're doing 2 contracts, you do 1 contract here and you do another contract here. So you scale in bit by bit. Okay. So once you're there, and by the way, you can use a 3-point stop. That is 3 S&P points. If you're doing this on the Dow, then you want to do like 30 points, something like that. All right. And then what you do is you wait for the move C. That's a C wave, which is in the same direction as wave A. Okay, so remember, C wave is in the same direction as wave A, and this is where the money is made. All right, so notice that wave C came about here. Boom, and went lower. Now, what you want to watch out for is, this can get a very rocky, it's very volatile, but you got to be patient here. All right, so the important point is, the way you manage this trade is, once the market has taken out the lows that wave A made, so once you go below the lows of wave A, which was here, okay, then you bring your stop. So you put your stop somewhere here, for example. All right, you bring your stop and you bring it to break even. Okay, that way you're in a risk-free trade, so you don't lose anything if it goes against you. All right, and basically what you do is just trail your stop. You trail on a 21-period moving average, the blue line you see there. Trail your stop until finally you get stopped out somewhere here. Okay, so if you look at this trade here, if you're entering at, let's say you get in at 1636, you exit at 1616. Okay, so you're talking about a 20-point move in this trade. 20 points, that means $1,000 per contract if you're doing S&P future contracts. So that's $1,000 per contract. Okay? So if you're doing 2 contracts, that would be $2,000. Okay, remember it's $50 per point. That's why. For more information about trading the markets, whether you're a beginner or advanced trader, visit my website, leadingtrader.com. Thank you.